welcome to CNBC TV 18's Mumbai Newsroom. I'm Sumaira Abdi and you're watching MF Corner. On the show today, we have Mrin Agarwal, financial educator and director at FinSafe India, who will be talking about how to go about planning for your children's higher education and the 3 portfolios you should not be missing out on. Also, a little later, we'll connect with Dilshad Bilamoria, Managing Director and Principal Officer and MF Advisor at Dilsa Consultants, to talk about what to be wary of when you're investing in NFOs, new fund offers. So first up, let me invite Mrin Agarwal, who's a financial educator and director at FinSafe India. Thanks very much, Mrin, for joining in. And, you know, there are a lot of people, I'm sure, who are looking to plan for their children's higher education. So let's start with, you know, what are the basics that need to be kept in mind there?
So good afternoon, Sumaira. Yes, and as a parent of a child who's also going to go to college pretty soon, it's pretty concerning because the biggest thing that impacts the education cost is, of course, the inflation. And inflation on education has been traditionally above 10%. If you're looking at going abroad too, the inflation has increased. You've got rupee depreciation as well. So it's quite a double whammy if you're planning to send your child abroad. So I think, you know, the basic thing is to get the amount that you need to invest right, because a lot of times what I typically see is people saying that I need 20 lakhs or I need 50 lakhs, and they don't take into account this big inflation number. So just to give you an idea, like typical education costs would be anywhere, higher education costs would be anywhere between 20 and lakhs to about 2 crores if you're sending your child abroad. And just if we take an example of a 50 lakhs goal that you need 10 years down the line, you need to be investing 56,000 rupees per month. So, you know, that's the number involved. And hence, I think there are a lot of calculators which are available online that you can use to figure out how much you want to invest, but get that inflation number right.
Yeah, absolutely, because, you know, it also matters greatly the amount of time that you have ahead of you, right? Because a lot of people, you know, still continue to choose very traditional options. Say, you know, if somebody's child is 5, like in my case, my child is 6, what would be my options? Because, you know, traditionally a lot of people would either go with the real estate that they have or you know, the children's education plans which are available. Is that the right way to go about it?
Oh, I think the children's education plans are like a big no. They only give you between 4 and 5% returns, and hence you're never going to be able to really keep up with that inflation number that we're talking about. You know, as far as property is concerned, I think it's fine to have it, but again, it depends where the property is. And typically, if you look at residential real estate returns, it's in the range of about 7 to 8%. Plus, the bigger factor is that people don't actually sell the property when the time comes, right? Because it's one of those tangible investments where you tend to get an emotional bonding as well. So I would still say that for a child who's 5 to 6 years old and who has about 10 years to go for the education goal, I would still say that equities is a great option to look at, because you have a longer period of time. You can, of course, choose a whole host of mutual funds to invest in. So you have the time and you have the options as well.
Okay. But, you know, for girl child, would the Sukanya Samriddhi scheme make any sense?
Yes and no. So again, if the child is less than 5, I think it makes a lot of sense, especially if you are a conservative investor and you don't want to take any risk at all, then yes. But the point to remember with Sukanya Samriddhi is that the withdrawal rules. So at the age of 18, only 50% of the accrued corpus can be withdrawn. So keep that in mind. And which is why if the child is less than 5 or 6 years old, it's okay to do it, but not really if the child is more than that, because you don't have enough time to really grow that corpus.
Okay, fair enough. So what about kids who are older? You know, you spoke about kids who are in that, you know, roughly 5-6 year age bracket. What about kids who are 10 or 15? Because, you know, I mean, at least once you're 15, you wouldn't necessarily have the time again to invest in equity funds, right?
Yes, unfortunately, for children who are 15 and the parents are planning now, or let's say the parents have come into some amount and they want to put it away towards the child's education, certainly they will have to look at more fixed income options, maybe like fixed deposits. Of course, if the period is above 3 years, the short duration debt funds would turn out to be more tax efficient. I would also go to the extent to say that if you are willing to take risk, maybe a small amount into a balanced advantage fund, but that's a lot of risk that you're actually taking. So I would still prefer to stick with the short duration funds or fixed deposits. For children who are 10 years old, there is some time. So I think there are various investment options. Of course, equities, within equities, I would say index, flexi cap would be better options compared to choosing mid caps or small caps. And if you don't want to take a pure equity risk, you can also go in for the balanced advantage funds. They do have automatic rebalancing as well. So those are not bad options too for children of that age.
Okay, Amrin, you had said earlier a strict no for these children's plans, right, which come in from mutual funds. Is that only because of returns, or are there more reasons?
Actually, the strict no was for the child plan from the insurance companies.
Okay.
Now, mutual funds do have the children education plans. Typically, these are managed as balanced funds. What I find is that the aggressive hybrid category actually gives a better return than these funds. And, so from a returns perspective, I have found the aggressive hybrid category to be better. However, if, for example, you are not able to invest in such a way that you say that I have chosen this fund and I'm going to use it only for child education, if you're finding it difficult to do that tagging, then you can go in for the children's education plans as well from mutual funds. But remember, there are other options to get better returns within the mutual fund space.
Okay, so then the sensible thing would be to treat this like any other, portfolio, which invests in, say, diversified equity funds or whatever. You may want to add gold, etc. Right? I mean, rather than go for a tailor-made plan.
Oh yes, yes,
okay.
Absolutely. And gold can also be looked at, but in the sovereign gold bond scheme only.
Okay, and when because a lot of people would be looking to send their children abroad, would it make sense to have some sort of dollar exposure? I mean, I know currently for mutual funds there is a ban on further investments overseas, but should people seriously consider other avenues?
They could consider it, but see, the point is that when you look at, if you're looking at investing abroad, for example, and the fixed return options are giving much lower returns, right? So you will have to kind of weigh the pros and cons to really see what works better. But yes, you could look at some amount of dollar exposure as well.
Okay, and of course, the biggest issue over here will be that you must account for the kind of inflation that is there. But education itself is becoming costlier by the year, and especially if you were to look at graduate or postgraduate level education, it's becoming very, very costly now. So, is it better to err on the side of caution and sort of save for more than what you have planned?
Yeah, absolutely. And I think, it's really difficult when the child is small, but certainly if the child is older, let's say 12, 13 years old, it would be good to get an idea whether the child wants to go abroad, because there is this big trend of children wanting to go abroad for undergraduation. And if you are like planning for undergrad in India and then suddenly your child says graduation abroad, there's a huge amount of difference. It's like 20 lakhs to 1.5 crores, right? So that's a huge amount of difference that you have. So certainly it's better to err on the side of caution.
All right, Mrin, thanks very much for joining in and for explaining how to go about this.